Thank you for joining us. Welcome to Business Incorporated. I am Bisi Adebayo. Coming up on today's program, digital lenders in Kenya back plan for the central bank to regulate their industry. Namibia to sell 60% of fishing rights to urgently raise money to fight the coronavirus pandemic. And Uganda's central bank leaves benchmark lending rate unchanged at 7% after 2 straight cuts. Well, let's begin the program with intraday numbers from the markets, and the Nigerian All-Share Index appears to be returning to winning ways with a 0.14% increase at about midday. In South Africa, the JSE Index was also up 1.45%, while the EGX 30 was 0.32% in the red as at intraday. Kenya closed Monday's session down 0.28%. And major stock markets in the Gulf rose at intraday, with the Abu Dhabi index boosted by gains in international holdings shares following a sharp rise in its second quarter profit. Dubai's main share index gained 0.16%, and that was led by a rise in Emirates NBD Bank and a 0.8% increase in blue chip developer Emma Properties. The Qatari index rose 1.12%, helped by gains in petrochemical firm industries. And Saudi Arabia's benchmark index was also up 0.83% at intraday. Similarly, European stocks advanced this morning despite heightened tensions between the U.S. and China. Annette Weichbach joins us live from the Frankfurt Stock Exchange for more of what's driving the markets at this time. Good afternoon, Annette. It's good to see you again after a long while. So global shares are rallying as investors keep a close watch on negotiations over a U.S. stimulus plan. What are they expecting?
Yeah, actually, shares do actually perform very well today. It's a mixture of some positive news out of Russia, that apparently Russia had a breakthrough development when it comes to a vaccine against COVID-19. It remains to be seen how credible and how trustworthy that vaccination is going to be, because there's also reports that there hasn't been like a large trial in the country, but still it's kind of lifting the mood. And of course, there's hope that there will be new and more stimulus on the way in the United States. Currently, there's a gridlock in Congress, but given that there are also going to be elections this year, investors do think that there will be movement. Eventually, there will be a new economic stimulus package also in the States. In addition to that, the Bank of England deputy governor was making sure in an interview that they also stand ready to increase quantitative easing in case the economy is turning worse than currently witnesses. And so I guess investors do like that scenario of potentially more stimulus to come.
As investors now, Annette, how are they reacting to the just released August ZW survey for Germany and Europe?
Yeah, that's also a positive surprise. It came out at 11, shortly after 11 local time here, and the ZEW expectation index was a lot better than was expected by the Reuters poll. In that index, actually, investors are asked about their expectation of the economic recovery. It's a poll among institutional investors and analysts, and they are expecting the recovery here in Germany to be pretty strong and also pretty broad-based, and that is also helping shares, I guess, to kind of rebuff that shock even further, and expecting a positive development also, especially for the car shares, which are rallying today.
Now, German biotech CureVac is among the hopeful candidates to come up with...
I think we've lost connection.
All right, we'll get back to Annette in just a moment, but let's touch down with Asia and see how the markets performed. Of course, they were mostly higher on Tuesday, and that followed gains on Wall Street overnight as investors remain unfazed in China, or by China's retaliatory actions against the United States. But China's mainland markets gave up gains in the afternoon. The Nikkei 225 advanced 1.88%, and the Topix index was up 2.54%. At 1,585.96 as the Japanese market returned to trading following a public holiday on Monday. South Korea's Kospi index gained 1.35%, while Australia's benchmark ASX 200 advanced 0.47%. The Hang Seng index in Hong Kong was up 1.92% in late afternoon trade, but the new technology index slid 1.01%. China's mainland shares gave up earlier gains to finish lower. And let's head now to London. Of course, stock market traders haven't been daunted by the news of the biggest quarterly fall in the UK employment in over a decade. The shares jumped in London in the morning, with the blue chip FTSE 100 index rising by 1.7%. But let's get the intraday updates from Juliana Olainka at our London studio. Good afternoon, Juliana. The market must have fully digested the latest employment figure. Has it made any difference for sentiment at intraday?
Good afternoon, Busy. Well, this morning we had some more gloomy macro data out of the UK economy, and that showed that since the pandemic, over 750,000 people have lost their jobs. In July alone, that figure stood at about 81,000. Just about an hour ago, we had some breaking news concerning the department store Debenham. As many high street stores have been, they have been struggling before the COVID-19 pandemic, and they've just announced that they'll be cutting 2,500 jobs from their stores and their warehouses. That's a massive story, and it will have huge implications not only for their stores around England, but certainly for some of their flagship stores, including the one that's just about a stone's throw away from our studio. At the moment, unemployment still hovering around that 3.9%, and that's really because of the government's furlough scheme, the job retention scheme. There are apparently about 9 million employees on that scheme. It will come to an end in October, and what we're expecting is a job tsunami in late autumn, and that's obviously not being reflected in the information that we received today. This sentiment doesn't appear to have knocked any happiness out of traders, might I say, because as you said, the FTSE opened in positive territory, and at intraday it's actually creeped into triple-digit climbs. The all share is up 2.18%. The FTSE 100 is up by 2.45%, and the FTSE 250 is up by 1.70%. Now, in currencies, the pound is also up on the US dollar by 0.15%, down on the euro by 0.31%, and up on the Japanese yen by 0.3%. It's worth mentioning, Bissy, that Intercontinental Group, they are one of the highest risers on the FTSE this morning. Intercontinental Group are the owners of Crown Plaza and the Holiday Inn hotels. Their shares are up by 6%, and that's because they released their first half of the year trading report, and even though their profits are down by a whopping $200+ million, the fact that they say that the costs of running the hotel have been kept low, that seemed to have cheered investors, and they have a positive outlook for the rest of the year.
Now, do you see this data influencing Rishi Sunak's decision to end the furlough scheme, even as the TUC General Secretary calls on the government to extend the job retention scheme?
No, in short, Bissy, that's been said on the record. And I think even if you speak to the majority of the British public, everybody knows that the furlough scheme cannot go on forever. It's good that you mentioned the TUC and the unions, not just the unions. There have also been calls from the opposition Labour Party, in particular the Shadow Chancellor of the Exchequer, Annalise Jobs. They're asking and wondering why the furlough scheme has been so broad that it should be sector-driven and sector-related, and that when it does taper off in October, they should look at individual sectors by themselves. But earlier this week, Rishi Sunak, the Chancellor, did say that the government have tried their best. They've done as much as they can, and they do know that there are some jobs that unfortunately will not exist. There are certain schemes that will replace the job retention scheme in October. There are new schemes that the Job Centre will be rolling out to try and encourage youth employment. I believe there are bonuses that will be given to employers if they are going to take on young apprentices. There's also the furlough job bonus. So every employee that an employer takes back, they will receive £1,000. There has been lots of criticisms for that because the opposition Labour Party believe that some firms would have taken back those staff anyway. So why give the money to them when the money could be going elsewhere? According to some estimates, the job retention scheme has cost the UK taxpayer £14 billion every month. And according to the Office for Budget Responsibility, the amount of money that the government have spent during the coronavirus pandemic is in the excess of £300 billion. So it's sad to say that, unfortunately, it's not looking likely that the furlough scheme will be dragged on come October.
Aside from the data, Juliana, tell us, what are the other headline grabbers driving market sentiment today?
Well, Bissy, it's another day, another story about the labour market. This time it's come from the Heathrow chief executive, John Holland-Kaye, who I've got to tell you during this lockdown has been a key figure on British media, doing the rounds, trying to talk about what's happening with the travel and tourism industry. He's been somebody that's really been pushing and putting the government to task. He has been warning again today, the British government, that their rules on quarantine and self-isolation is hemorrhaging the already pretty damaged tourism industry. They have had some data talking about passenger numbers in July, and in July, which was still quite busy, their passenger numbers were down 88%, which is absolutely massive. We know that the government have reimposed some quarantine on travel, what once were travel corridors, including Spain. More recently, any people coming from Luxembourg, Belgium, Bahamas and Andorra, they have to self-isolate for 14 days. There are massive talks at the moment and speculation that potentially France could be on that list because the number of infections in France has dramatically increased, so we're expecting that to come any day now. I'll just very briefly say, Bissy, that Mr. Holland-Kaye, the Heathrow Chief Executive Officer, did say that tens of thousands of jobs are being lost because Britain remains cut off from critical markets such as America, Canada and Singapore. The government can save jobs by introducing testing to cut quarantine from higher risk countries while keeping the public safe from a second wave of COVID. So not happy at the peak of the summer season that the passenger numbers are just not there.
All right, Juliana, thank you. We'll see you again tomorrow. Futures tied to major U.S. equity averages were up in early morning trading on Tuesday after days of gains on Wall Street pushed the S&P 500 within striking distance of a record high. Dow Jones Industrial Average futures were 138 points higher earlier, and that pointed to likely gains of 118.56 points at market open. The S&P 500 and the Nasdaq 100 futures also pointed to opening gains. For the 30 stock, Dow gained about 350 points in regular trading on Monday, posting its seventh positive session in a row, and that's its longest winning streak since September 2019. The S&P 500 gained 0.2%, sitting just 0.9% below its record high set in February. Meanwhile, the Nasdaq underperformed with a 0.4% loss as investors rotated out of some high flyers. Crude oil gained more ground on Tuesday with prices driven by expectations of U.S. stimulus and a rebound in Asian demand as economies reopen. Brent crude added 0.6% to $45.38 a barrel, while U.S. crude rose 1.14% to $42.42 a barrel. Prices found support after U.S. President Donald Trump tweeted that top congressional Democrats wanted to meet with him on coronavirus-related economic relief. But analysts also say that a weaker U.S. dollar helped support higher oil prices as well. Meantime, gold fell on Tuesday as the dollar firmed after Beijing slapped sanctions on U.S. officials in the latest flare-up in tensions between Washington and Beijing, with investors also keeping a close watch on negotiations over a U.S. stimulus plan. Spot gold was down 0.5% to $2,017.98 an ounce, moving further away from a record high of $2,072.50 hit last week. U.S. gold futures fell 0.6% to $2,028.10 an ounce. Silver dropped 0.6%, trading at $28.97 an ounce, and platinum fell 0.7% at $979.50, while palladium rose 0.5% to $2,231.31. We won't be talking about the impact of deforestation on Nigeria's agricultural productivity when we return in just a moment. Please stay with us. Welcome back. Between the year 2000 and 2016, Nigeria recorded the second fastest deforestation rate in the world, next to the Republic of Togo. Some analysts believe that deforestation is leading to social strife in the country, including herdsmen and farmers' clashes, amongst others. It's also projected that global deforestation will accelerate further during this period of the COVID-19 pandemic. A research analyst at the financial derivatives company Nneka Okolo would be speaking to us about the implications of this. Good afternoon, Nneka. Thanks for joining us on the program. Now, what are the implications of this abnormal rate of deforestation on the agricultural productivity of the nation and its GDP?
Well, trees are quite relevant to the ecosystem in the sense that in terms of oxygen generation, carbon dioxide absorption, and soil fertilization. So deforestation, which in the simplest terms means removal of trees, is broadly negative on the environment and more so for agricultural productivity. This is because higher rates of deforestation would increase the risk of soil degradation and erosion, which is of course negative for crop cultivation, and more so decreased vegetation would imply higher levels. Decreased vegetation would in one way or the other affect livestock production. Given these facts and the fact that the agricultural sector contributes is the third largest contributor to the overall GDP, if the deforestation rate is high, this would in turn affect agricultural productivity and also the GDP, more so as we are trying to shift our weight from the oil sector.
Now, Nneka, the Financial Times reported that global deforestation accelerates during the pandemic. Does this mean that the deforestation trend will continue to intensify in Nigeria like other countries the world over? And what can be done to buck this trend?
Well, the report is based on the fact that the current economic situation is driving exploitation of forest resources, and we can see this happening globally. Now, Nigeria's economic situation is still weighed down by increasing unemployment levels as well as rising inflation rates. So given this, we'd expect the deforestation rates to continue to be on an upward trend, and in order to buck this effect, it'd be advisable to divert the attention of those who are actively contributing to deforestation in Nigeria through the introduction of tree growing schemes and sensitization of people, especially in rural communities.
But how will the reversal of this trend minimize social conflicts in Africa's largest economy?
Well, social conflicts in Nigeria, which the herdsmen and farmers clashes is the most rampant, and arises from disputes over land resources. Now, because on one hand we have the herdsmen who need vegetation to rear their cattle, and on the other hand we have farmers who are actively involved in crop cultivation. So if these land resources are available in adequate amounts, I believe there will be no need for these clashes to occur, and so it's quite evident that a reversal of this deforestation rate would help reduce social and political conflicts in Nigeria.
Research analyst at the FDC, Nneka Okolo, thanks for your time on the program.
Thank you.
In other stories now, digital lenders in Kenya have thrown their weight behind a plan for the central bank to regulate their industry amid concerns that they are placing borrowers under increasing debt stress. In a statement released on Monday, the Digital Lenders Association of Kenya says regulations should be based on the Digital Lenders Code of Conduct. The lobby group also wants to promote transparency, best practices for debt collection, market-based pricing with no hidden fees. Kenya is among the first countries where digital lending, mostly using a mobile phone, went mainstream. Staying in Kenya, Equity Group Holdings plc will now pay $95 million instead of the $105 million agreed for a 66.53% stake in Congo's Bank Commercial due to the fallout from COVID-19 pandemic that has affected revenue. According to the Nairobi-based equity firm in a statement, the merger will birth the largest banking entity in Democratic Republic of Congo after acquiring ProCredit with a combined balance sheet of more than $2 billion. Kenya's largest lender by market value is losing $1.11 million monthly due to waivers for mobile banking transactions to minimize the use of cash during the pandemic. And to Namibia now, where the Fisheries Ministry has announced plans to sell 60% of its so-called governmental objective fish quota to foreign fishing vessels to urgently raise money to fight the coronavirus pandemic. Along with tourism, beef and mining, fishing is one of Namibia's main sources of foreign exchange. The Fisheries and Marine Resources Minister, Albert Kawana, explains that government is in need of financial resources on an emergency basis with a view to mitigate the effects of COVID-19. The auction, the first of its kind, will see the sale of the right to catch 72,000 tons of horse mackerel and 11,000 tons of hake. 40% of that will be reserved for local buyers. In addition, the right to catch 392 tons of monkfish will also be sold to the highest bidder. Uganda's central bank has left its benchmark lending rate unchanged at 7%, pausing after two straight cuts aimed at reviving economic growth affected by the COVID-19 pandemic. The central bank expects economic growth in the 2020-2021 fiscal year in the range of 3 to 4%. In a statement, the governor, Emmanuel Tumushime, explains that the economic outlook is extremely uncertain, largely because of the unpredictable intensity and duration of the pandemic. The World Bank expects economic growth in Uganda to fall as low as 0.4% in 2020 from 5.6% last year as the effects of the virus batter sectors including tourism, exports and manufacturing. And that's where we end today's program. Thank you for watching. I am BC Adebayo.